Welcome to Accounting with Professor Lamptey. Today we are looking at one of the most important ideas in accounting, cash basis accounting versus accrual basis accounting. In the last lesson, we looked at the accounting cycle. We learned that accounting is not just about recording random numbers. It follows a process. We analyze transactions, record journal entries, post to the ledger, prepare a trial balance, make adjustments, prepare financial statements, and then close the books. That is the accounting cycle. But before we go deeper into adjusting entries, we need to answer one very important question. When should a business record revenue and expenses? That question may sound simple, but in accounting, timing matters. If you record revenue too early, the business may look better than it really is. If you record expenses too late, the business may look more profitable than it really is. And if you record everything only when cash moves, you may miss the real story of the business. So today we are going to compare two important methods of accounting, cash basis accounting and accrual basis accounting. By the end of this lesson, you should understand the difference between the two, why accrual accounting is important, and why adjusting entries exist. Imagine this. You clean someone's house today. You do the work, you move furniture, you clean the kitchen, you clean the bathroom. You even clean that one mysterious corner nobody wants to talk about. But the customer says, "I will pay you next week." Now here is the accounting question. Did you earn the revenue today or next week when the cash comes in? Most people may say, "Professor, I want my money first." And I understand, cash is wonderful. But in accrual accounting, we do not ask only when cash came in. We ask, when was the revenue earned? Cash basis accounting is the simpler method. Under the cash basis, revenue is recorded when cash is received. Expenses are recorded when cash is paid. That is it. If cash comes in, record revenue. If cash goes out, record expense. Cash basis accounting is like saying, "Show me the money, then I will record it." For small businesses, personal finances, or very simple operations, cash basis accounting may feel easy to understand. Let's use a simple example. Suppose your business provides services to a customer in March. The customer pays you $1,000 in April. Under the cash basis, you record the revenue in April because that is when you received the cash. Now suppose your business uses electricity in March, but you pay the electric bill in April. Under the cash basis, you record the expense in April because that is when you paid the cash. So cash basis accounting follows the cash. If cash has not moved, nothing is recorded. Very simple. But there is a problem. Business activity does not always happen at the same time as cash movement. That is where accrual accounting becomes important. Accrual basis accounting gives a more complete picture. Under the accrual basis, revenue is recorded when earned. Expenses are recorded when incurred, not necessarily when cash is received, not necessarily when cash is paid. This is the big difference. Accrual accounting asks, did we earn the revenue? Did we incur the expense? Cash is important, but cash is not the only thing we look at. Let's go back to the same example. Your business provides services in March. The customer pays in April. Under accrual accounting, the revenue is recorded in March because that is when the service was provided. The business earned the revenue in March. Now let's look at the electric bill. The business uses electricity in March, but pays the bill in April. Under accrual accounting, the expense is recorded in March because that is when the electricity was used. The business incurred the expense in March. That is accrual accounting. It focuses on when economic activity happens, not only when cash changes hands. This is why it gives users a more complete picture of the business. Now let's talk about revenue recognition. Revenue recognition answers this question. When should revenue be recorded? Under accrual accounting, revenue is recorded when it is earned. Usually, revenue is earned when goods are delivered or services are performed. That is, when the performance obligations have been met. Let's use a simple example. A landscaping business cuts grass for a customer on June 25th. The customer pays on July 5th. When is the revenue earned? June 25th. Why? Because that is when the service was performed. Cash was collected later, but the revenue was earned in June. Now imagine the business receives cash in advance. A customer pays $600 on June 1st for 3 months of service. Has the business earned all $600 on June 1st? No, the business has received cash, but it still owes the customer service. So the business records a liability called unearned revenue. As the business provides the service, it recognizes the revenue. This is an important point. Receiving cash is not always the same as earning revenue. That is why timing matters in accrual accounting. Now let's talk about expenses. Expense recognition answers this question. When should expenses be recorded? Under accrual accounting, expenses are recorded when they are incurred. That means expenses are recorded when the business uses goods or services to help generate revenue. Suppose employees work this week, but payday is next week. Should the business wait until next week to record the wage expense? Under accrual accounting, no. The employees worked this week. The business incurred the expense this week. So the expense belongs in this period, even if cash is paid later. Now let's bring in one of the most important ideas in accounting, the matching idea. The matching idea means expenses should be recorded in the same period as the revenues they help generate. This helps users see a more accurate measure of profit. Let's say you run a small bakery. In March, you sell cakes and earn revenue. To make those cakes, you used flour, sugar, eggs, electricity, labor, and maybe a little prayer because baking can be stressful. Now imagine recording the cake revenue in March, but recording the flour expense in April, the labor expense in May, and the electricity expense whenever the bill decides to show up. The numbers would be confusing. That would make March look too profitable. It would make April or May look worse than they really are. Accrual accounting solves this problem by matching revenues and related expenses in the same period. If the revenue belongs in March, then the related expenses should also be recorded in March. Let's compare the two methods using one example. Assume your business provides consulting services for $2,000 in December. The customer pays in January. Also assume you incur $500 in wages in December, but you pay the employees in January. Under the cash basis, what happens in December? No revenue is recorded because cash was not received. No wage expense is recorded because cash was not paid. So December may show zero revenue and zero expense from these activities. But is that what really happened? No. The business worked, the employees worked, the revenue was earned, the expense was incurred. Under the accrual basis, December shows revenue of $2,000 and wage expense of $500. That means December shows net income of $1,500 from those activities. This gives a better picture of what happened in December. Now you may be asking, Professor Lamptey, why should I care? Good question. You should care because financial statements are used by real people. Owners use them, managers use them, banks use them, investors use them, government agencies use them. If revenue and expenses are recorded in the wrong period, financial statements can mislead users. Now let's connect this back to video 5 on the accounting cycle. Before financial statements are prepared, we make adjusting entries. Now you can see why. Adjusting entries exist because accrual accounting exists. If revenue has been earned but not recorded, we need an adjustment. If an expense has been incurred but not recorded, we need an adjustment. If a prepaid asset has been used, we need an adjustment. If unearned revenue has now been earned, we need an adjustment. If equipment has been used over time, we need depreciation. Let's close with a few common mistakes. Cash basis and accrual basis are not the same. Cash basis follows cash. Accrual basis follows earnings and incurring. Receiving cash does not always mean revenue. Paying cash does not always mean expense. The better question is, what period does this belong to? Here is the simple recap. Cash basis says, record it when cash moves. Accrual basis says, record it when it happens. Revenue happens when it is earned. Expense happens when it is incurred. And most importantly, accrual accounting explains why adjusting entries are needed. So when we move to the next video on adjusting entries, remember this. Adjusting entries are not there to punish accounting students, even though sometimes it may feel that way. They are there to make financial statements accurate. Thank you for watching Accounting with Professor Lamptey. If this lesson helped you, subscribe for more simple accounting lessons. I will see you in the next video.